Hey folks, welcome to Oregon Cash Flow Pro. My name is James Barber and I'm here to help you maximize your cash flow. I've been having a really good email exchange with somebody and we're talking about index universal life policies and illustrations. And there was a lot of really good questions asked and some good information. You're going to get a lot of value out of it, so stick around.
Oregon Cash Flow Pro offers free money management advice to help you take control of your finances. And now here's your host, personal finance enthusiast and licensed insurance broker, James Barber.
First, let's go over his initial email after I sent him a couple of indexed universal life illustrations. One of them with a decent design and one of them with an optimized cash value design. He writes, "The optimized cash value design is much better. The cash value and the death benefit were way too far apart in the first design, which accelerates costs more during old age." That's exactly right there. "These are the few questions I have. There are a lot of riders attached, which can also drive up cost. Which ones are necessary? I already have some passive income and I will generate more, so I don't need the riders." He goes on, "If I pay a lump sum during certain months, does that determine the segment the funds are applied to?" He's referring to index crediting segments. And then he asks, "How often can I switch which index I'm participating in? What would be the trade-off using the cash value assessment test instead of the guideline level premium? And how do we know the loan rates and how often do the variable rates change? What are the terms?" So a few more questions. He says, "This mentions that it turns into a MEC, which I don't want. So do I have to stop funding the policy or reduce the premium? I think what I'd prefer is to stop paying at age 60, and then I'll decide if I want to draw on those funds or leave it there." And he finishes with, "Can you also tell me what you don't really like about this product?" I think that's a really good question. Thank you for the assistance and info. So in my initial email back to this person, I like to address each question in order and I like to number them. So it's really easy to know which one is being answered at which time. To his first question, I said, "The riders on the illustration I sent you are all included at no cost." Now this is a National Life illustration that I sent him. I said, "That's one of the best things about National Life and why they have a place in my personal portfolio. More specifically, the living benefit riders serve as a pseudo long-term care policy."
Here's a list of the riders included at no cost in National Life illustrations. You'll notice the accelerated benefits riders, they have 4 of them. These are the ones that are very similar to long-term care policies, and I find a lot of value in them. Also notice there's a charity matching death benefit protection rider, an interest crediting strategies rider. This one is one that some other companies charge for. They may offer you an attractive raised floor of 1 or 2%, but then they charge you a couple of percents to participate in the index rider. So it's kind of a bait and switch in my opinion. Below that, you've got the lifetime income benefit rider, where you can turn your cash value into annuitized payments. And then we have the overloan protection rider, which is one of the key riders to make sure you have. It is the ability to basically turn the IUL into a paid-up policy, much like the reduced paid-up policy that you see in whole life insurance. And then at the bottom, the systematic allocation rider, which is the ability to have your index segments allocated monthly. But James, this one says that there's an additional cost to this additional protection benefit rider. What's up with that? The additional protection benefit rider is kind of like the term insurance that we blend with whole life in order to reduce the cost of insurance and allow for that cash value growth during the first couple of years that you normally wouldn't see. So the cost for this rider is actually the cost for that additional insurance that we're purchasing. And it's a lower cost than if we were to have all of that insurance included within the face amount.
Second question. My answer, yes. When you make a payment, it is applied during the next segmenting period. National Life does monthly segmenting.
Now, the default for allocation of excess contributions is for all of them to be credited at the very next segmenting period. However, recall that you have the systematic allocation rider, so you can opt to have all of that excess broken up over 12 periods and allocated accordingly. Very similar to a dollar cost averaging approach, but not really. Keep an eye out for a future video where I'm going to do a deep dive into systematic allocation, and I'll compare the performance to just one allocation per year, because I want to know which one works better over the long term for cash growth.
Third question. You can switch indexing options at each policy anniversary. So once a year is the frequency. Question number 4. Cash value assessment test, or CVAT, results in higher death benefits, meaning you pay more life insurance costs than you would under the guideline level premium test. There's only a few circumstances where the CVAT is preferred, including when we're designing a mech purposefully, ensuring the greatest death benefit, and short-term max funding of a policy that would otherwise exceed the guideline level premium limits. So cash value assessment test is calculated by the cash value in relation to the death benefit, whereas the guideline level premium is calculated by the premiums paid relative to the death benefit. So just to be clear, one of those is calculated by the cash value that your policy grows into, and the other one is calculated by the premiums that you pay into the policy. So typically with a high cash value policy that we design where you're planning to fund it, especially an IUL, where you're going to fund it for a number of years and use it for retirement, we're going to almost always go with a guideline level premium. Number 5, the loan rates and guarantees are initially spelled out in your policy agreement. The variable rates can change at any time, but only adjust for your policy once a year on your policy anniversary. There are no set payback terms, no minimum payments or due dates. You pay back the loans on whatever schedule you want. If you pass away with an outstanding loan, the death benefit pays off the loan and any accrued interest.
Question number 6.
This policy does not become a mech as designed. The guideline level premium, in this case, was $15,753. It will not become a mech unless your premium exceeds that amount for the average of each year you have the policy, meaning you can deposit less than that some years and more than that other years to catch up. Now be sure to stick around when I address his response to my questions, because I missed something in that illustration, and I'm going to apologize for that answer in just a few moments. Number 7, the design of these policies and your early max funding of premiums allows you to stop paying premiums at any time near retirement without much concern for it not being sufficiently funded. Many people plan to use policy loans to access the cash value throughout retirement without adding in additional premiums. And there's always the option of using the overloan protection rider at age 75 if you would like to just withdraw as much cash value as you can and turn off the premiums. What that does, it effectively closes out the policy without actually closing it out so that you don't face any tax consequences. Number 8, what I don't like about the product the most is not having access to the cash value in year 1. It limits the amount that I would open a policy for initially. Additionally, I don't like that the guarantees for cap rates and insurance costs have the ability to get very unfavorable for the insured, however unlikely that may be. That's the trade-off to have a shot at the possible cash value growth, though. So those were my answers to his 8 questions that I had identified in his email. And he responded to that email with some more good questions. So to my question number 2, he says, segments are very confusing on my TFLIC policy, probably because there are 3 blended indexes, so I'm trying to understand it better. If my date for segment 1 is June 1st to May 31st, then does the S&P 500 or whichever index have to post positive gains for the same exact time frame? Yes, basically. Each index option will lay out its segmenting period. If your segment 1 date is June 1st to May 31st, and the index option is the S&P 500 annual point-to-point, then the policy gain will reflect the change in value of the S&P 500 at the end of trading day on June 1st and at the end of trading on May 31st. Now, not all indexes are annual point-to-point. They range from monthly to even 2 or 3 years. So that's why I had to specify that that's only if that indexing option is the annual point-to-point. So whatever index option you choose, you have to look at what its segmenting periods are. I personally just use the S&P 500 annual point-to-point because it's historically done well, and I consider changing indexes to be like trying to time the market, meaning it's very, very difficult to time it well. You're usually reacting to whatever happened the previous year. You're not necessarily going to be changing into an index option that will perform favorably the next year. You got to be real careful about jumping around with those indexes. The S&P 500 over its historic average has done very well. In fact, most fund managers don't even keep up with the S&P 500 average. I'm pretty happy with the average, but the only way you're going to get the average is if you stick with that year after year. So that's my philosophy. You're certainly welcome to do what you want with your policies, but that's how I view using those indexes. Then he responds to my number 6 question, where I said the policy does not become a mech as designed. And he says, okay, I don't know why the illustration shows this message then. This policy becomes a mech in year 24. I've got a little egg on my face on that one. So I said, I apologize, my mistake. I went and re-looked at the illustration again. I looked at it briefly after he made the initial comment, and I thought, no, that doesn't become a mech. I remember looking at that illustration. What happened is we have an option change from an increasing death benefit to a level death benefit that on the original illustration I put in, I did it at age 75, which did not create a mech. But if we're funding this policy at $15,000 a year and we change that option to happen at age 65 instead, it created a mech, and I missed it when I printed that illustration. So I had changed the option to option B from a prior illustration, and I didn't realize that that message had popped up about the mech. So I included a new illustration with premium contributions stopping at age 60, as he had indicated in his previous email, and then the mech was no longer a problem. The options change still occurs at age 65 now. You can still make $15,000 contributions all the way up until age 60, and as long as you stop before age 65, when we make that death benefit change, it does not become a mech. So when we make those death benefit changes makes a big difference, and that will come up in one of his next questions. So then he goes to my number 7 question, and he says, can I switch to a level death benefit in year 20, or does that have to be part of the design? So the death benefit change can be made at any time. It doesn't happen automatically though. I can play with it as part of the design so that we can see where it would benefit the most and where it would hurt. As in the case above, as we saw, with the funding originally illustrated, changing the death benefit option from age 75 to 65 ended up resulting in a mech. So the same thing can happen if we move it up to a 20-year. But these don't happen automatically. So while your policy is in force, we continue to look at it. We continue to look at how you funded the policy. And when you're ready to make that change, or preferably a few years before you think you might want to make that death benefit option change, we'll do an in-force illustration and we'll see what we need to do to make sure that it's not going to turn into a modified endowment contract. Now, why do we do the death benefit change? This might be something you're asking when you're watching this. The reason we do the death benefit change is because with the increasing death benefit of option B, which helps us maximize cash value growth in the early years, once we get older, when we get to retirement ages, that increasing death benefit gets very expensive, and you could end up paying $50,000-$60,000 a year for a policy that you're only getting a benefit of a couple $100,000 of life insurance, higher than whatever the cash value growth is in your policy. So what we do is we change it to a level death benefit, we reduce the amount as much as possible, and just like with most of the things we do, we try and minimize those insurance costs. So what happens is you get the advantage of an increasing death benefit, all the cash value growth for the whole policy through its whole lifetime. And then once it gets to the point where those costs start to go up, we change it and we reduce those costs, because we're not after a really high death benefit. What we're after is high cash value growth that you can use these policies in retirement to help fund your retirement. And question number 8, where he asked me about what I don't like about the policy. He says, why do you say that you don't have access? I didn't notice a limitation in year 1. As long as there's cash value, it seems to be accessible. He's absolutely right there, except it just doesn't indicate it anywhere on the illustration. And I'm not sure why that is. I've looked and and they just don't put it on there. But I own one of these policies, and the contract itself does state that you can't use it, and I actually tried. You can't use it in the first year. There are ways that you can access your cash value in a cash value life insurance policy in the first year outside of the insurance company, but it's more complicated, and it's not really recommended because it's just not as easy. It doesn't have any of the benefits that come from actually having a loan from the insurance company. You have to go to a bank, you got to get approved for it. It's not very difficult. They like cash value life insurance to be collateral for a loan, but they're still going to pull your credit. You're going to have a repay back period. They're going to have a claim on your life insurance policy and the cash value. So later on, when you want to access more cash value, now you need to get their approval to be able to make any changes to your policy. So it's something that not many people want to go through, but you do have that option. So if you start a policy, it's an emergency, you want to get access to it, and it's just too early, that is an option that you can access it, but not recommended. We usually try to not get one of these policies if you think you're going to need to access it in the first year, or we design around it so that maybe you go the first year with a low premium and then you catch up later, put in more money. But as with all of these things, the more money you put in sooner, the more opportunity you have to grow your cash. But that is an option. If you just are not interested in having no access to your money in the first year, you can start off by paying the base premium in the first year and then do the increased paid up additions after that in year 2 and on. He goes on to say, does National Life have a history of lowering caps and participation levels or increasing other fees? No, not really. I mean, National Life is pretty good historically. They're one of the only companies that publishes their cap history publicly. I haven't seen them make any adjustments to participation levels or increase other fees. Just know that it is a possibility according to the contract. As for lowering caps, all IUL products from every carrier have been lowering caps intermittently for almost a decade. It's largely a result of the volatility in the market, and carriers become a bit more conservative after offering these products for a while and their popularity. The larger caps were kind of like new product incentives, I think. Once they got popular, they just don't have to make them quite as attractive. So they don't. They're still selling record numbers of these index universal life policies. I think what we're going to see is we're going to see the insurance companies test where the market is at. At what point will the cap levels be too low that people will want to stop buying into them? And once we see that point, we'll probably see them level off. And we may be around those points now. Hopefully we are. I don't want to see the cap rates go lower than they are now, but the insurance companies do have to watch their bottom line and take care of their policy owners. I hope you got some good information out of that. Remember, this is about index universal life insurance. And if you want to find out more about these types of policies, check out this video here and this video here. And if you found value in today's video, be sure to hit the like button and subscribe down below. Now go maximize your cash flow.